A lot of Singaporeans have always seen ECs as the safe middle ground. Cheaper entry price than private condo, potential upside, you just need to wait 5 years MOP and then maybe upgrade later. But after this latest policy change, honestly, I think the government is very clearly trying to change the entire mindset. Because if you look closely, this is not just a small change, a small tweak. This changes who gets access to ECs, how buyers enter, how long buyers stay, and even how developers price future launches moving forward. And I genuinely think this is not just going to affect future EC buyers, but also existing EC owners, HDB upgraders, and even parts of the private condo market. So in this video, let's break down what exactly changed, why the government is doing this now, and more importantly, what this means for you moving forward. So first, let's simplify the changes. There are basically 4 major shifts in the EC segment for future land tenders moving forward. The MOP is now extended from 5 to 10 years. Then, first-timer quota is now increased from 70 to 90%, and the priority period is extended significantly to 2 years. And deferred payment scheme is now removed for future EC launches. Now, honestly, when you look at these individually, they may seem like separate policy changes. But if you zoom out for a second, right, all of them are actually pointing towards one direction. ECs are slowly shifting away from a short-term vehicle that you can buy and potentially flip in 5 years for a profit, and really moving back towards more long-term own-stay housing. And I think that is the real story here. Let's start off with the biggest one first, which is the 10-year MOP period. Because I think this changes buyer psychology completely. Previously, a lot of buyers, right, not all, enter ECs with a very clear game plan. Buy at launch, wait for it to build, plus another 5 years MOP. Then potentially sell, rent out fully, or upgrade later. Whether people openly say or not, this was honestly the mindset for many buyers. But now, future ECs require 10-year MOP before full flexibility. With this, the entire equation changes already. Because, think about this for a second, waiting 3 to 4 years for construction and another 10 years MOP, total 13 to 14 years is a very long commitment. During this period, you still cannot rent out the whole unit, you are locked in for much longer, and your ability to reposition your entire asset roadmap becomes much less flexible. Honestly, it starts becoming quite similar to the PLH BTO model, the plus and prime flats. Because what happens if, let's say, given today's budget is a bit limited, maybe given your current financial situation and all that, you can only afford a unit, let's say a smaller 3-bedroom. Then in a few years later, your family grows. Even if your intention is not to flip the property, but genuinely for family needs, right, you cannot just simply redeem that 10-year MOP and say that you want to move. In that way, your ability to upgrade becomes much later already. So the key question becomes, are you buying this EC because you genuinely want to stay long-term? Or are you still looking at it mainly as a stepping stone? And are you very sure that this home can still suit your family needs 13 to 14 years later? Because under the new framework, those are 2 very different things now. And honestly, I don't think this affects genuine long-term own-stay buyers that much. But for buyers who value flexibility, or buyers whose strategy rely heavily on the 5-year timeline, this becomes something you really need to think through carefully. Now, the next change, I think this one already explains a lot about what has been happening in the EC market over the past few years. The first-timer quota increased from 70 to 90%, whereas the second-timer quota reduced. If you look at this historically, it was actually 95, 5 back in 2012, then gradually shifted to 70-30, and then now we're back to 90-10 again. Then the next change is very underrated in my opinion, the extension for the first-timer priority window. Previously, first-timers only had a relatively short head start, just 1 month. Meaning, if you miss that timing, that's it already, it's gone. But now, the runway becomes significantly longer, and this completely changes the dynamic. Because now, it's no longer, can you rush in fast enough? Instead, it becomes, can first-timers slowly position themselves properly before entering? And I think that is a very important difference. At the same time though, this also means the second-timers may increasingly start looking somewhere else. And this is where things become interesting. Because if future ECs become less attractive from a flexibility standpoint, where does that demand go? Some buyers may start looking at existing ECs that are still under the old framework, with 5-year MOP, deferred payment scheme still available, and earlier flexibility, whereas some buyers may even jump straight into private condos instead. Now, on paper, private financing may allow buyers to borrow more due to TDSR versus MSR, but realistically speaking, private condos still have a meaningful price gap from ECs, about 20 to 25% more. Hence, overall quantum is still more expensive. So it is a higher entry price, higher monthly commitment, and not everyone will comfortably stretch that. Which means, moving forward, we may actually see a split in buyer behavior. Some move to private, some stay within ECs, some shift towards older or existing EC stock instead. And honestly, this redistribution of demand may become one of the biggest effects of this policy change. And I think the more important question is, why is the government suddenly making such a huge adjustment now? Now, if you zoom out and connect all of these changes together, I think the government is really trying to solve two core issues here: affordability and access. Because EC prices have already increased very significantly over the past few years. We are already seeing launches crossing 1,009 or even 2,000 per square foot. And naturally, as prices rise, first-timers slowly struggle more and more to keep up. At the same time, developers continue bidding land higher because demand remains extremely aggressive. And eventually, the risk is EC slowly starting to behave too similarly to private condos, which was never really the original intention of ECs. So from the government's perspective, these policies are probably less about controlling prices directly and more about reshaping market behavior, slowing aggressive demand, reducing that flipping mentality, and rebalancing buyer mix, and also encouraging longer holding periods, and indirectly helping ECs remain more accessible moving forward. Then if you look at the trend over the past few years, the first-timer participation in EC launches have actually been falling. This is not the exact proportion for every EC launch, but directionally this has been the trend in the overall EC market. Previously, first-timers formed a much bigger portion of EC buyers. But over time, second-timers started dominating more and more. And honestly, it's not that difficult to understand why. Second-timers naturally move faster. They already own a property, they have already accumulated capital over more years of working, and they are usually more financially strong. So in many launches, what ended up happening was first-timers came in interested, but second-timers were simply able to move faster and absorb remaining units much faster. So I think from the government's perspective, ECs were slowly drifting away from the original target audience, and this policy is essentially trying to rebalance that. Not necessarily to punish the second-timers, but to create more breathing room for the first-timers again. And honestly, I actually think this may completely change how future EC launches behave. Because moving forward, I don't think we will keep seeing this same kind of ultra-aggressive sell-out launches like before. Demand may still be there, but the pace may become more gradual. And personally, I actually think this may be healthier for the market overall. Now, let's talk about the Deferred Payment Scheme. Because I think a lot of buyers, right, they initially see this as, wow, the government is making things harder again. But honestly, I think the deeper intention is more about financial prudence. Previously, under DPS, buyers pay around a 3 to 5% premium on the purchase price, and in return, they can defer servicing the bulk of the loan until much later. For some first-timers, they like the idea of starting their mortgage later. For second-timers, DPS also helps them avoid servicing two loans at once. However, I think the removal of DPS will greatly deter many second-timers beyond just the issue of servicing two loans at once. Because in the past, many HDB upgraders could structure their finances in a very specific way. They could continue staying in their HDB flat first, pay the 20% down payment for EC, and then use this deferred payment scheme together with bridging loan, such that nearing TOP, their income may be higher, thereby taking a higher loan. Then, the remaining payment can come from their HDB sales proceeds plus loan. But now, without DPS being on a normal payment scheme, buyers will now have to access their current income to determine their loan now. And most second-timers may have to sell their HDB much earlier first. Otherwise, they will need a substantial amount of cash without relying on their HDB sales proceeds. And also, bridging loan becomes much less practical because without deferred payment scheme, the bridging loan timeline may stretch close to 3 years from EC purchase to HDB sale nearing TOP. By then, the interest incurred may become too significant already. So I think the government is now shifting the focus towards not just whether buyers can enter, but whether buyers can comfortably afford. Because moving forward under the normal payment scheme, buyers will now need to be much clearer from the get-go in terms of their timeline, cash flow, sale coordination, when your mortgage starts, and overall affordability. And honestly, I think this is the key shift. the market is moving away from how I can structure this purchase most aggressively towards, am I genuinely financially ready for this purchase? These both are very different mindsets. So from all these changes, what are the likely immediate impacts? Firstly, 10-year MOP will reinforce the idea that ECs are meant more for long-term own stay. Buyers now really have to zoom out and think carefully whether this home genuinely fits their plans for the next 13 to 14 years. Secondly, with the higher first-timer quota and much longer priority period, first-timers now definitely have more room and time to enter the EC market. But at the same time, I do feel the new 90% quota may take longer for first-timers alone to fully absorb. Which means, moving forward, we may no longer see the same kind of ultra-high take-up rates during launch weekend itself. And lastly, the removal of DPS. For first-timers, this means taking the loan and starting mortgage much earlier, but for second-timers, planning now becomes extremely crucial. Because many may no longer have the privilege of staying comfortably in their current HDB while waiting for the EC to TOP, coupled with the much lower quota allocation, entering the EC market now becomes significantly harder for second-timers. Then you may ask, how does this impact the developers? I think the developers now also have to recalibrate how they bid for the future EC land size. Because if the demand is shifting more heavily towards the first-timers, developers have to become much more conscious about affordability and how much they are bidding for the land. Can they still sell well? Can they still maintain the profitability that they are looking at? Because I think this become much bigger considerations moving forward. And because again, the buyer profile is shifting more towards the first-timers, developers may also have to rethink the pricing strategy, the unit mix, and overall positioning to better cater towards affordability. Now, we're not saying that EC prices will suddenly crash or see a huge dip. I don't think that's the intention at all. But I do think the government is trying to moderate and stabilize the EC market and slowly bring it back towards the original purpose of EC housing. Now, personally, I think one very important implication here is this. The existing EC stock suddenly becomes much more interesting. Because they are not affected by the new rules, you still have the 5 years MOP, your deferred payment, earlier flexibility, and earlier privatization timeline. So for some buyers, especially the second-timers, this may generally feel like, wow, this is one of the last window of opportunity under the old EC framework. And naturally, whenever markets go through this kind of policy split, buyers start paying much more attention to timing. Not just, is this EC good? But which version of EC market am I entering today? So it's a very different question altogether. And honestly, looking at where the EC prices have already moved towards, with some projects even crossing 2,000 per square foot, it is quite obvious why the government felt the need to step in. So there are still 5 upcoming EC sites under the old ruling, mostly around the Senja and the North region, your Woodlands, Sembawang, Yishun area. With less than 2,000 unlaunched units remaining, I personally do think that these launches may see very strong demand because many buyers may view this as one of the last opportunities under the old EC framework. But even then, for the ECs under the previous 30% quota, there is still very heavy dependence on ballot queue number and affordability. But also, if we are looking specifically at the East region, there's really only one last remaining option left before the new ruling takes place, which is Costa Cabana, around the Loyang Besar area, with limited units remaining, right, with 3 bedrooms currently at the point of filming, from around 1.53 million to 1.67 million. And honestly, because of all these new rulings, buyers really need to sit down and think through their timeline properly. Because if you already know that you are likely going to this EC route, then naturally you also need to set some form of timeline or deadline for yourself. Yes, there are currently 5 upcoming EC launches under the old ruling, but the question is, will you wait until all 5 launches are gone and only then start exploring alternatives? Or perhaps after the second or third launch, if it still doesn't work out, then maybe it's time to step back, reassess and look at other options earlier. And honestly, EC is not for everyone. If you are considering the private route instead, where you have a much shorter runway, you just need 4 years to clear your seller stamp duty and potentially lower cash outlay, there are still a few interesting opportunities in today's market. For example, Nara Residences at Dairy Farm. There are still good units remaining, and I've actually done a full analysis video on this project before, so if you haven't watched that yet, you can click above and go and watch it first. So assuming an EC 3-bedroom at 1.7 million average price. Because of income ceiling and MSR restrictions, your maximum loan may only reach around 1 million, which means your upfront down payment that is needed is around $700,000, haven't include your buyer's stamp duty. Whereas for a private condo like Nara, under TDSR, you could potentially purchase a 3-bedroom around 872 square feet at around $2 million. But you can see from here that your upfront outlay is significantly lower at around $500,000 only. Another example could also be Hudson Place residences in the One North district. I think this is also a location worth exploring because it is a city fringe location, but still priced closer towards the outskirt levels. I've also done an analysis on that. And by the time this video is up, the project will have already launched, so it depends on the units available and the actual price point. But assuming a 3-bedroom at 893 square feet, you can see from here this layout is actually very functional. You have 3 very good sized bedrooms, plus also your bathrooms and your kitchen comes with windows, allowing a very good own-stay livable element. And assuming this 3-bedroom at let's say 2.15 million, the down payment outlay is still significantly lower compared to many buyers trying to enter an EC under the MSR restrictions. So again, I'm not saying that private is automatically better than EC. Different buyers will have different priorities. But what I am saying is this. Moving forward, buyers really cannot just look at headline prices alone anymore. You need to look at flexibility, cash outlay, holding period, your whole financial structure, but also your long-term life plan altogether. To end things off, now, am I saying that everyone should rush and buy immediately? No, I don't think it is that simple because different buyers will see this policy very differently. For genuine long-term own-stay buyers, this may not be a huge issue. But for buyers prioritizing flexibility and upgrading and their future restructuring, the trade-offs becomes much more important now. So moving forward, I think the real question is no longer can you afford the EC? It's more of are you comfortable with the version of EC ownership moving forward? And honestly, I think that is the biggest shift from all these changes. So if you are currently exploring ECs and trying to understand whether entering now still makes sense, whether existing ECs may be attractive, or how these changes affect your own upgrading timeline, feel free to reach out. Happy to walk through your numbers, timeline, and options properly. And also, if you want more updates on the policy changes, the pricing shifts, and also new launch analysis, you can also like and subscribe to my channel. So thanks for watching, and I'll see you at the next one.